When a bear market handles a violent purge of speculative retail capital, the typical investor stares blankly at chart patterns, token price drawdowns, and social media sentiment. The noise right now is completely obsessed with these superficial metrics. People are asking if a token is down 80% or if its X engagement has collapsed. The signal, however, lies in a cold, hard fundamental that legacy finance has used for centuries. The cold, hard fundamental: revenue. In brutal market conditions, token emissions and inflationary promises go to zero. What survives and what thrives are the protocols that generate real, unleveraged cash flow. Today, we are running a comprehensive masterclass dissecting a golden rule. Any protocol displaying high revenue during rough market conditions demands a permanent spot on your close watch list. We are pulling back the curtain on the top 10 protocols generating massive last 12 months LTM revenue while sitting comfortably under a sub-$1 billion market cap. We will analyze the core mechanisms of these 10 fee engines, forecast their revenue sustainability through the depths of this bear cycle, and project exactly how their cash flows will react when the macro environment shifts and a true bull market unleashes global liquidity. My name is Noel. Welcome back to the Signal and Noise podcast. Let's dive in. Let's start at the absolute peak of the list with the ecosystem that has turned capital efficiency into an art form: Solana's liquidity and routing stack. Sitting at number 1 with a staggering $56.4 million in LTM revenue is Meteora. Meteora isn't just a simple automated market maker, it is the dynamic liquidity layer of Solana. Its dynamic AMM pools and DLMM setups allow liquidity providers to capture ultra-precise fee tiers by concentrating capital where trading volume actually occurs. It acts as an organic fee machine because it dynamically reallocates idle capital to yield lending protocols when trading volume lulls. Working hand in glove with Meteora is Jupiter at number 8, clocking $10.2 million in LTM revenue. Jupiter is the premier routing matrix of Solana, managing the vast majority of all ecosystem trading volume. Its revenue stream is incredibly robust because it draws from a diverse product ecosystem: spot routing fees, its native dollar perpetuals platform, and launchpad utility. Bear markets are characterized by sudden concentrated bursts of programmatic trading, liquidations, and meme token capital rot. Because Meteora and Jupiter capture fees on the velocity of capital rather than the asset's nominal price, their revenue engines run constantly. When macro parameters loosen, specifically when global central banks lower interest rates and inject fiat liquidity, retail capital returns to high-velocity chains. As decentralized trading volume swells by an anticipated 10 times to 15 times, Jupiter and Meteora will sit directly at the protocol toll booths, scaling their revenues straight into 9-figure territory. Now let's look at the foundational bedrock of decentralized credit and staking infrastructure on Ethereum and across the multi-chain landscape. Coming in at number 2 is Aave, pulling in an exceptional $21.9 million in LTM revenue. Aave is the undisputed king of decentralized money markets. Its revenue engine is remarkably pure. It takes a direct percentage slice of the interest paid by borrowers. Anchoring the 10th spot is Lido Finance with $6.6 million in LTM revenue. Lido is the infrastructure layer for liquid Ethereum staking. It takes a flat 10% fee on all staking rewards generated by the protocol. In a bear market, leverage demand compresses, but Aave offsets this through liquidation fees during market flushes and steady institutional borrowing of stablecoins. Lido's sustainability is practically locked in place. As long as the Ethereum network requires validation, Lido will continuously extract revenue. When a bull run returns, the demand for on-chain leverage explodes. Aave's utilization rates spike to the ceiling, causing protocol revenue to go vertical. For Lido, an appreciating ETH price coupled with a surge in retail staking participation means the dollar-denominated value of that 10% protocol fee scales dramatically. Let's transition to the protocols serving as the primary liquidity hubs for Ethereum's fastest-growing Layer 2 networks and alternative ecosystems. Sitting comfortably at number 3 is Aerodrome Finance, commanding $21.5 million in LTM revenue. Aerodrome is the undisputed liquidity hub of Coinbase's base network. Using a refined VE3,3 tokenomics engine, 100% of the protocol's trading fees are routed to voters. At number 5, PancakeSwap continues to prove its status as an absolute cash flow titan, racking up $13 million in LTM revenue. Its multi-chain expansion into Arbitrum, Base, and Ethereum mainnet, combined with its version 3 concentrated liquidity upgrades, has protected its fee capture mechanics. Aerodrome's secret weapon is its deep structural integration with Coinbase, ensuring a steady baseline of trading volume even in a bear market. PancakeSwap faces tougher competition across its multi-chain footprint, but its massive, sticky retail user base ensures stable swap fee retention. Aerodrome is positioned to be one of the largest beneficiaries of the next bull cycle, as Coinbase routes millions of mainstream accounts directly to on-chain apps. PancakeSwap will capture massive long-tail asset trading volume across alternative layer 1s, driving token buybacks and burning mechanics to historic highs. Finally, let's sweep through the rest of the list, covering decentralized compute, scaling layers, order books, and novel network security primitives. At number 4, EtherCloud generates $16 million in revenue. Meanwhile, Polygon, at number 6, claims $12.5 million. EtherCloud builds an enterprise-grade decentralized GPU compute network tailored directly for AI processing and high-end cloud gaming. Polygon draws consistent income from transaction execution fees across its POS chain and growing ZK-EVM scaling stack. At number 7, Lighter secures $11.3 million, and at number 9, Ore holds $9.6 million. Lighter acts as an ultra-fast, institutional-grade order book infrastructure for decentralized applications. Ore holds revenue via its novel proof-of-work security mining network built directly on top of Solana. Ether's revenue is decoupled from crypto cycles due to AI demand. Polygon and Ore depend on active transaction volume, meaning natural compression in troughs. These are the ultimate high beta multipliers. When institutional macro capital returns, Ether sits at the convergence of AI and Web3. Polygon's ag layer will bundle millions of transactions daily, while Lighter will underpin the back end of high-frequency trading apps. Let's bring it all home to the definitive fundamental truth. The noise says buying in a bear market is financial suicide. The signal protocols, with proven double-digit million-dollar LTM revenues, are the absolute bargain values of this cycle. They are active, working commercial enterprises. The move focus your attention on the cash flow engines. When global liquidity flows back, these fee-collecting protocols will dominate the financial frontier. The cash flow never lies. Stay sharp, stay focused. That's it for this edition of the Signal and Noise podcast. My name is Newell. Do like and subscribe. Stop trading the hype and start tracking the revenue. Please, this is not financial advice. Do your own research. We'll see you on the next block.